on different financing options. That being said, give it up for Matt.
So it's been awesome getting to know each and every one of you, like a little bit. Some of you haven't spent enough time with me yet. I haven't spent enough time with you, probably the other way, right? So I'm excited that we're here and going through all this stuff. We're gonna just break this stuff down in a really simple fashion, right? Innovative lending options for real estate investors. So this is just beginning to advance, so no matter where you are in the process, I'll probably touch on something that you can get some value out of. Let's do the next one. All right, cool, so my qualifications. So I purchased my first home in 2011. Based on my experience with what happened, I hated the process. It was completely atrocious. So I realized that there was a great opportunity for me to get into the world of home loan financing, and from there I immediately switched over. I was working at Chase Bank, switched over to the mortgage lending opportunity there. From Chase, I launched their Lending Tree program, which is online leads. It was horrible, I hated it, but I learned a lot. I went to Bank of America, I launched their e-commerce platform. That was also a lot of fun, and then I went to BMO as a VP. I was with them until 2018, and then I transitioned after being laid off from BMO Harrison to be independent mortgage broker. So any of you guys worried about like starting your own thing, it took me actually losing my job to actually get off on my own, but it was definitely the best thing that happened. My core values are pretty simple. It's just transparency, education, and client-centric approach. What that means is I want to talk to you guys about where you're at, but I don't want to like lose the educational piece out of it either. I like to teach people about how this stuff works, because at the end of the day, I will never understand your situation better than you do, right? You can tell me everything you want to, but I just don't have enough time to learn who you are like through and through. Client-centric approach is pretty simple. It's like we're going to tailor that mortgage based on what you're telling me, but if it ever feels like something's off or we need something different, I'm always going to add my 2 cents and give you guys that information based on what I understand as well. Let's go ahead and hit the next slide. All right, so we've all heard about house hacking, right? So our definition for that is just using a primary residence to generate rental income. You can do this by co-living spaces and renting out rooms there, kind of going through that process. The loan products that you're really gonna use for this on a conventional sense are gonna be either the conventional loan, your VA, or your FHA. Your credit ranges are gonna be from 580 to 680. That's your ranges that you have to be in before you can even start to go through these processes. The down payment options are anywhere from 0 to 5% on the low side. They go a lot higher if you want to. And you have to live in that home for at least 12 months, right? So we want to make sure that we are always being honest and truthful, but if there's a reason you have to move out of that house before the 12 months is up, you know, you can always make that choice. Just make sure you talk to your professionals about that before you do it. This is a phenomenal strategy up to your 4th home, okay? So you can go buy that first home with 3.5% down on FHA, or if you're a veteran, you know, use that 100% financing, buy that next house, do that next house, and just rinse and repeat over and over and over again, okay? Yep.
So a question with that, I kind of had thought of a strategy. My brother needed to buy or wants to buy his own place, and so if I would like to have a duplex or a triplex and whatnot, can I help him buy the house or buy a duplex or something, and we work out some kind of deal to where we can use his FHA loan and then work rentals through that, like if I supplied the cash.
So if you want to give a gift, right, to help him purchase the home, you could definitely do that on FHA, right? I was worried you were going to ask me about VA because I know you're a veteran. And on VA, that's not allowed. You have to be the owner-occupant on VA. But FHA, if you're not going to occupy that house, you could definitely represent it as a non-occupant co-borrower. Does that make sense? Okay, so yeah, and if you want to just give him the money for it. Yeah. And FHA is not just for first-time home buyers, okay? I can get an FHA loan. I've had 7 homes. I'm allowed to have one, right? He can have one. He has like, how many do you have?
Who? Me?
Yeah.
Oh, personally 5.
Okay, yeah.
20.
Yeah, so FHA can be used at any point in time. The difference between looking at an FHA versus conventional is your loan limit, right? So FHA has a little bit of a lower loan limit. It's got higher private mortgage insurance. And depending on what's going on with the market, the rate may be higher or lower than your conventional loans, right? But it's important to always talk to somebody, look at all the options, figure out which one fits your needs best, and then you kind of make that choice. Good question. Anything else on this one for our new ones? Good? Everybody okay? Cool. Let's hit the next slide. All right, so what qualifies as a primary residence? First off, there are a few things that have to qualify for a primary. So if you're thinking about doing house hacking, getting yourself 3, 4 homes, right, going through that process, you have to keep all these things in mind. If you have a phone, take a photo. It's very important, okay? Especially if you're gonna do it. So first, it needs to be substantially closer to your place of work. This really only works for W-2 paid employees or if you rent an office space, okay? If you're saying, hey, it's only 5 minutes closer to work, but I live 45 minutes away, that's not substantially closer, right? Most of the time you want to get at least half the distance. The other option is going to be 10% or more in square footage or an extra room, extra bathroom, right? Also, you can do it for downsizing. So when you get a little bit older, right, a little bit riper, you can do, start to retire, your kids move out of the house and you're like, hey, I want to get a smaller home than my current home. You can buy that because you're downsizing as well. If you're in your 20s or 30s, it doesn't usually work out to downsize. Yes?
Silly question maybe, but what if your place of work is that you work from home?
Yeah, so depends on where your office is located, and that's a really good question. But like, if your situation is I work from home all the time, I don't physically go to the office at all, we don't have an office location here in Arizona or the state that you're looking to purchase, then you would always be looking for a larger home to do a primary home, okay? Because you work from home, so you can't move closer to work because you're already there.
Yeah.
Right? Yeah. So you would always, if you want to use primary, right?
Closer to the master suite.
Right. Yeah. That could work, right?
Like with my job in particular,
Right.
I sell to a territory, but there's no office anywhere near
Well,
here.
so territory is a really different one though, right? So if you say, hey, I sell in this territory, which is like Phoenix, Scottsdale, and right now you live in Surprise. Well, you could buy a house in Tempe because it's right next to Phoenix and Scottsdale, right?
Yeah.
And it might be a little bit further drive for you to go that way. You're like, hey, it's closer to my territory. Your employer could write you a letter and that would work for a primary.
Arizona half, so it's like anywhere in there.
But if your main accounts and most of your business is done in Scottsdale and your manager wrote a letter stating that you do most of your travel to Scottsdale and you bought your house in, let's say, Surprise for the first one, and then you're like, I want to buy one a little bit smaller, but I want to move to Scottsdale because I'm working there all the time, we could use that to do a primary, right? Each situation is a little bit different with these. This is why it's always important to consult somebody. But like a simple way to think about it is, let's say you have a W-2 paid job and you work at Phoenix Children's Hospital in Phoenix, right? And you currently own a home in, let's say, Gilbert, right? And you're like, hey, I want to get closer, I want a house hack, and I want to buy a house in Scottsdale, or I want to buy a house in Phoenix. You could buy a 2-bedroom there as a primary, even though you're living in a 3-bedroom. And then your next house after that could be a 3-bedroom back in Gilbert again because you're buying a larger home. Does that make sense? So you just have to be able to kind of put it all together in your mind and understand how that process is going to work for you. So that way you're kind of future-proofing those other deals as opposed to getting stuck in this massive home that's like 2 miles away from work and you can never move out of it because you can't afford to buy a 1.5 on a house hack.
And as you do that, do you have to reclassify your original mortgage as a non-primary residence?
That's state-specific guidelines based on how the counties run that kind of stuff. So like Maricopa County, I believe you have to register. I know Texas definitely have to register those as rental properties, right? There's homestead acts and all kinds of stuff like that comes into. So check with your state and local municipality, but it will not affect your mortgage company. It only affects your state taxes, residential property taxes. Good question, really good question. Yeah. Any other questions on this one? This is a big one for a lot of people, so. Any confusion? No? Let's do the next one. All right, so investment loans. So basically, these are going to be financing investment properties that you're going to be purchasing, right? Your credit range needs to be 680 plus. Down payment is 25% on these conventional loans. Your interest rates are going to be higher than on your primary residence loans, so you're going to be paying a little bit of a bump there, right? Which is never good for cash flow. These are non-owner occupied properties, so you're not going to live in it, you're not going to stay in it. Sometimes you don't even see it. And the benefit to this is it allows you the ability to grow your portfolio from that 4 to 10 loan range, right? A lot of banks, like larger banks, don't want you to have more than 4 mortgages on your credit, okay? And so when that starts to happen and you get to that like 5th home and you're looking at it and you're like, I want a house, it's really hard to do another primary in that situation if you don't already have investment properties that are purchased. So in that case, you would usually use an investment style loan, especially if you're not going to live in it. The banks are going to start to see your credit profile. They're going to start to see that your taxes show a ton of rental income, and they may force you to go into one of these as well.
I have a quick question
Yeah.
with that 4 limit. Is that 4 mortgages at a time?
4 mortgages on your current credit report. So your personalized credit, anywhere from 4 to 10 is usually when you start to see those investment loans kick through. Now, I've got banks that'll do you all the way up to 20 homes, right? But when you're looking at this with other people, which you guys should all shop your mortgages with somebody besides just me, gives you a good understanding of where things are at. This is some of the stuff you might see from them. And these are pretty industry standard for the larger banks like Citi, Bank of America, Chase. They don't like to see more than 4 mortgages most of the time. Am I projecting enough for you guys back there? Sorry, I got kind of quiet. Yeah. All right, cool. Any other questions about investment property loans? Yes.
What about, I've heard of one guy that I know, he does improvements in lieu of down payment. Can you explain how that would work or how you even present that to a bank?
Yeah, so those are more like 403B loans, or it's an FHA style product, but they take into account that you're going to be rehabbing the house as opposed to going through that. The main way you're going to hear about that online through those other sources is somebody buys a house with 5%, they do a bunch of repairs to the home, then they refinance out of that PMI and they no longer have to pay that PMI, right? Because it's a lot better for you to have a nicer house with less money out of pocket, and you can do a lot more sweat equity that way. Does that make sense? Really good investment strategy though, and something you guys should all look at, like red carpet, blue walls, good house, right? If it's in a nice area. Cool. Any other questions about this one? Let's go to the next one. All right, so we're gonna get a little bit more off into the weeds here, okay? So we got DSCR loans. This stands for debt service coverage ratio loans, okay? And I'm gonna break each one of these down. These are based off the rental income of the property, okay? Now with what we do here at Growth House, looking at co-living spaces, that's called border income, okay? You cannot use border income for DSCR loans. So if you have 5 people living in the same house, you can't take all 5 leases and say, I qualify for a debt service reduction or a debt service coverage loan, okay? They're gonna base it off of what that house can rent for in a normal market. This is why it's so important to have your cash flow ratios down when you're looking at those homes and you're going through a DSCR, okay? Nice thing about this, not personal credit. You can close it in an LLC, which is always really nice, right? They don't take your income into account either. As long as you've got the 15 to the 25% down and you have over 640 credit score, they'll basically loan you the house if it'll rent out for what the mortgage payment is. It's really nice, really slick. Yes?
What's the scenario where if you don't meet equity, what is the criteria that they wouldn't, ultimately lend you the money? Assuming you have that credit, percent down, is there any other boxes that you need to check to qualify for that?
Come on, man, you know this. You do these.
Well, no, I'm trying to get clear.
Yeah.
There's some that I'm just,
So primarily it's gonna be the rent ratio, right? So if your house mortgage payment is gonna be, let's say, $3,000 a month, and you can only rent that house out for $2,500 a month, they're not gonna qualify that product most of the time. They usually wanna see you rent out for 1 to 1.1% of what the actual rent's gonna be to make it actually cash flow. That way they know you can afford the house and you're gonna be able to pay it based on just the rents coming in. Because that's how they're qualifying you on that mortgage product. It's not your own personal loans, it's not your own personal credit, it's not your income, it's what the house can do, not what you can do. Does that make sense? Yeah.
Can you talk about there's usually prepayment penalties with DSCR? Can you touch on that?
Absolutely. So yeah, these loans on the non-QM loans, okay, for all non-QM loans, there are always the risk of a balloon payment or a prepayment penalty, okay? Most of the time, you're gonna wanna check those things with your lender to make sure you don't have a balloon payment or you don't have a prepayment penalty. You can usually buy those things out from them, but on most debt service coverage loans, you're gonna be looking at a prepayment penalty of like 2% on those. And the reason that's a risk is these come with a higher interest rate than your traditional investor loans, right? So if an investor loan today would be 8%, this might be a 9. So you wanna refinance out of that if you ever can, right? But if you have to prepay a prepayment penalty on it, it'll lock you in that 9% so the bank makes sure that they make all of their money off of you and you keep a little bit less of your profit, okay? It's really important to understand those kind of things. That was a great question. Did I answer that for you, Ramon? Okay, cool.
Did you do DSCR on single families?
Oh yeah. Yeah, single families, multifamilies, these will also go to 4 to 8 unit properties, sometimes 12, right? Depending on which banks you go.
On single family DSCRs? Or is it all personal?
They're all going to be recourse on most of these. The only one that we really do the non-recourse for is going to be it's not even on this page, it'll be the next one. Yep, so these are all recourse loans. Do you guys understand what a recourse loan is? It's where, like, if you don't pay the payment, the bank's going to come after you, right? If they lose money, you're going to have to pay them back. So make sure you guys make your payments on those. Any more questions about the DSCR? We good? All right, next is bank statement loans. Now, bank statement loans are actually pretty cool. So if you're a business owner, right, like myself, or like some of the other people here in the room, and let's say you write everything off on your taxes, because who really wants to pay taxes? Am I right? You may need to do a bank statement loan. These are going to be based off of your business bank statements and the deposits that you have in that bank statement as opposed to your individual tax filings, right? So all those deductions that you get off on your taxes, everything that you're writing off isn't going to affect you on that mortgage process when you're going through one of these loans. They will have prepayment penalties every once in a while. AJ knows about that. I did one for him a while ago. They also have higher interest rates that you're usually going to see, and they have some higher closing costs, right? The nice thing about them is, again, it's going to be a simplistic way of you getting qualified for your mortgage as opposed to providing tax returns for all of your businesses, your personal credit score, and all the other things that you're going to have to go through when you're qualifying for a traditional QM mortgage product. Questions on bank statements? I know this is super fun. Finance is great, right guys? All right, next we have our fix and flip loans. This is one of the things I was talking to Jesse about that he got really excited about when I brought it up to him. Fix and flip loans are a 12-month interest-only payment during construction, okay? Now when we talk about house hacking and we start looking at ways that we can grow additional homes into our portfolio, this is a great way for you guys to get a home, low amount down, and include all of the construction costs in that process as well, okay? Any guys in here do fix and flip already? We got one? Yeah, two? So we got two people that have done fix and flips. The cool thing about these is that they're not always gonna be based off of what you can qualify for. I mean, you're gonna have your own qualifications in there as well, but it's more of a relationship-based lending platform. So these are gonna be looked at as, you know, once you have that 15 to 25% down, if you've done 0 to 3, you're gonna be at 25% down. Once you cross over that third flip in your third year, you're gonna start seeing better down payment options and better rates because now they know you're experienced and they're not worried about losing all their money on your deal, right? The other thing is that these are based off of the after repair value on your home or your ARV. I always say AVR for some reason. What that means is that you're not putting down 15 or 20% of the actual house on its own. You're gonna be doing that plus your repairs, okay? And then you get to fund those repairs to that loan as well. So let's say you find a house for $250,000, but it needs $100,000 worth of work, right? If you're gonna do, let's say 10% down on something like that, well, it's 15 here, let's say 20% down on that, you're gonna be looking at a $75,000 down payment on that house, okay? That's a $250 plus $100,000 in work. That was quick math, I think I did it right, somebody check me. No? Okay. What happens at that point is they're gonna pay for that house, that $250,000, okay? And then you're gonna go do your repairs to it. You're gonna start working on things. You're gonna put in floors, kitchens, bathrooms, and you're gonna run out of the money that you have left over. When that happens, you're gonna send those receipts over to your mortgage company, and they're gonna reimburse you for those expenses, allowing you to continue that project all the way through to fruition. Does that make sense? So it's a really nice way for you not to have to leverage all of your capital that you're using all at the same time and be able to go ahead and do 2 projects as opposed to just being able to afford 1, something you probably could have benefited from. Also, they force you to track all of your receipts and billables. Usually you're gonna be using a general contractor or a licensed GC. Until you get that relationship built up really well, which he can probably tell you about that, they're not gonna let you do your own work until they know you know what you're doing, okay? These do come with a balloon payment on them as well. So after that 12-month interest-only period, there's a balloon, which means you have to pay off the mortgage, okay? If you can't pay off the mortgage at that time because you're not selling the house and you wanna convert it over to a DSCR loan, you'd have to refinance that house into one of the other products that we have. So make sure if you are gonna take advantage of a fix and flip loan and you're gonna use a house hacking type mentality or a co-living space, that you have additional capital there that can come up for any type of shortfall that you might have when you're qualifying for a debt service reduction loan or a traditional conventional mortgage. Does that make sense? Be really careful with those. Next is your NONI. This is for guys who are super high net worth. It is a no income loan for investors. Basically, if you don't want to qualify with your income, you don't want to give anything over, you don't mind a 12% interest rate, they'll give you a loan in the house with the right amount of money down, they don't ask any questions. Yes?
Is that advertising or I
For NONIs?
Yeah.
Interest only. Yeah, they'll do interest, well, you can do either one. It really depends on the kind of way that you want to do it. I didn't put all the loan programs on here, so I've got 120 investors that I shop through for these guys for you to make sure that we're getting good deals on them, but these are really great if you just don't want to spend all the time giving that documentation over. Yeah?
What's the net worth qualification?
There is no net worth qualification. You just got to be able to stomach that mortgage payment, right? They're usually going to be 25 to 35% down on those, depending on your relationship with the bank that we choose, but yeah.
How does that loan differ from like a hard money loan?
It's basically a hard money loan through a bank with an amortization schedule and you're making a payment to them. It's almost identical, right? Because you can find hard money sometimes, like back in 2021, we could find it for what, 9%, right? But now you're looking at 15. So sometimes you'll have a slightly better interest rate than hard money. The other thing is they're not gonna close as fast because they're gonna put you through like an appraisal process. They're gonna make sure the house qualifies. It's not just like, hey, I can go buy this, stake on a piece of land that we call a house. It has to be an actual home that's in livable condition, right? And that's why it has slightly better interest rates than hard money typically does. They do come with prepayment penalties. You can always buy those out, right? Slightly higher lender fees. So again, these are more of like ease, speed, and comfort, convenience, but you want to make your payment to a bank you trust as opposed to some guy who's going to try and steal your house.
Is that only for investors? I mean, investment properties?
For NONIs, yeah. That's all I can do them on right now. I've heard that some places are doing them on primary yet, but I haven't found anybody that I trust to do it. And the lending regulations around that just are too hazy that I wouldn't sell that to somebody right now.
It would need to be fully amortizing, and you couldn't do prepayments. They were gonna be
Right. Exactly. Yeah. That's why any bank that says, "Oh yeah, we can do them," I always look at them like, I don't know. Yeah. I appreciate the questions. Anything else you guys got on these ones? Yeah.
So just one quick
Yeah.
statement. So the fix and flip loans are fantastic. Just so you know, I found out yesterday, the day before, if you've ever heard of one of the bigger lenders right now is Fund That Flip. If you've ever heard of them, they're pretty big. Actually, one of the biggest flip lenders. But anyways, they're insolvent now. So they're really, really bad. So if you are working with Fund That Flip, just kind of note that there's going to be trouble. So
I'd love that you bring that up, actually. So in 2019, when COVID happened, right, I had a few loans in process with DSCR. I had a couple in fix and flips, right? And they shut down lending completely when they announced the COVID stuff, right? Like, we all knew it was coming, but it literally shut down lending. I had to call clients and say, hey, I'm sorry, they're no longer lending this program on your home that you guys decided to purchase, right? It was horrendous. We had pulling out our hair, trying to figure out a million things to do. A lot of apologies, right? I wasn't in control, but the banks can turn on and off their lending whenever they want to. This is why it's so important for you guys to work with somebody that has more than one option on these. Because every once in a while, something will happen and that bank shuts their doors, right? Or something else comes up where, they say, hey, sorry, you don't meet our credit profile anymore. And it feels like they're picking on you, but really, they just changed their guidelines around and you're stuck out in the rain without, anything that you could do about it. So make sure you have somebody that's set up that knows that this is one option and then we have a backup, right? Because those plan Bs sometimes will go through. Actually, AJ and I had to go through that ourselves once. It was horrible. I felt really bad about it. I was apologizing all the time to him. But I did save him, $80,000 on the purchase of your home? So, yeah, not a realtor. I can't. Yeah, you got it. All right, let's hit the next one. Any other questions about that one before we go? You guys good? All right, cool. So this is our blanket loans, also called cross-collateralization, okay? These are a little bit different, okay? A lot of people haven't heard of them before, but when you hit that 10, 20 mark properties and you're like, dude, my mortgages are getting sold all the time. I'm constantly having to go through servicing issues. I have to hire somebody literally to make sure all these payments get paid at the same time. And I really don't want this stuff in my personal credit anymore because nobody's gonna lend me money now that I have 20 mortgages, right? Well, these ones will actually combine all of your properties into one single loan. So they're ideal for high net worth investors who have multiple properties, not 3 or 4, we're talking 10 plus, okay? You do get pretty attractive interest rates with them. They'll close in an LLC. They are for real estate professionals only, okay? To qualify as a real estate professional, you have to have real estate professional taxes that are usually filed, meaning that's your only source or your main source of income. Not your only one, but your main one, where you get most of your income from. It reduces your risks and simplifies your mortgage management. And the biggest thing that people get out of this is that when those banks start to limit your personal credit and how you're going to purchase those homes, right? You kind of get taken out of the residential world and put into more of a commercial world. You lose a lot of protections when you do that, right? So once you hit this 20 number, which I hope everybody in this room gets 20, if not more, this is a great way for you to kind of free up your credit and be able to go back out there and rinse and repeat, kind of like we talk about, okay? Now, a lot of people don't understand how these work, so make sure you guys understand that if you do start looking at these ones, that you talk to a couple of people, because one person's never enough, right? There's always different terms out there. There's a lot of different banks. Most big banks don't know what these are and have no idea how to actually deal with them. And you have to look at the terms on these too, because they can come with prepayment penalties, they can come with balloon payments, 5 years amortization where you have what we call a defeasance fees in there, where if you don't refinance it, you got to pay $250,000 to the bank. So make sure you're really getting explained how these ones actually work when you get there. I hope everybody gets there. Once you have 20 homes, you're probably a lot smarter than you were when you had one home, right? So this stuff will be a lot easier for you, but yeah. Oh, by the way, non-recourse.
I was going to say, how do you qualify for non-recourse?
Yeah.
I used to do a bunch of multifamily and we did these, but I still had to PG them all.
It depends on the bank, right? So we can find banks that have non-recourse for them, and usually it's gonna be based off of your portfolio, your assets, your risk, what you kind of look like in that. And when you have that real estate professional business, you're gonna have business credit at that point too, right?
So I actually wasn't a full-time real estate professional. That's probably why I couldn't do it.
That would have been one. But if you start a new company with it, right, and you have the hours for it and it's your primary source of income, it's a great way to go. If you don't, just get a partner.
And it does have to be primary source of income?
Well, that's the real estate professional requirements, right? It's your primary source of income to write off all your real estate expenses, right? I'm not an accountant. Please don't quote that for anybody on YouTube. Yes?
I've actually got a blanket loan right now, and they do ask you questions like, how long you've been investing. Tell me about your experience. Like they definitely want to make sure. So one thing that, so I love the blanket loan. I took 4 properties, cashed out all that money, bought a ton more properties, which is great. The one thing that is interesting is it was a 5-year because it's commercial.
Yep.
It's not recourse, which is great. But after 5 years, I was like, oh crap, I have to refinance this. Great thing though, the interest rate was fine. It was still the same before I started shooting up. But I had to pay an appraisal fee.
On 5 properties.
Yeah, for all the properties. Like, what?
And the appraisals are way more expensive
So
too.
expensive, yes.
Yep, commercial appraisals are not cheap.
$2,000 now? Anyways, so that was just one little caveat, but it's great. I bought more properties and everything. So.
Yeah. No, that's a really good point. And remember, you're a real estate professional, so all those appraisals, those are write-offs. But I mean, that's what's great about it. And the other, yeah, they are. Yeah, commercial. You're going to go through that too with your commercial appraisal too. Yeah, 15, 20 grand, easy. Yeah. But these are phenomenal tools. Again, I've actually never taught somebody else about this loan that wasn't coming to me asking me for it. So you guys are really special here at our Mastermind conference. AJ knows I talked to him about stuff. I've talked to other people in this room about all kinds of products that I offer and all kinds of things that we can do. But again, make sure you talk to somebody you trust. Make sure you talk to more than one person, right? Don't just take the first quote. Make sure you guys are looking at those things with somebody else, right? I make a living off of this. The only reason I tell you that is because I want to look really good when I give you a quote and you talk to somebody else and they give you a really high one, right? No, I'm just kidding. It's more about your comfort level to make sure that you're working with the person that you feel like you trust, right? Because at the end of the day, if that guy or girl, whoever's helping you out through this process isn't really in it to help you and they're in it to help themselves, you're going to pick up on that kind of stuff really quickly, right?
Doing something like this, I can then go back to that primary residence and do 4 and do 3 key.
You could, yeah. But by the time you have 20, you're not going to need to use anybody. You're going to be cash flowing your own deals. You shouldn't be talking to a lender really at that point unless you're like, I want to hold this debt to write off all my taxes, right? And that's when those other kind of decision-making processes are coming in of like, well, I can buy 5 homes with this $500K or I can just buy 1 home, right? And then you're going to be in that mindset of like, how do I want to structure my business and what do I actually want to do? But these are options out there that a lot of people don't know exist. I mean, they'll have 5, 10, 15 homes and they're like, man, no bank will talk to me because all my credit's used up and they won't even give me a car loan anymore, but they're all rental properties. I'm cash flowing a ton, like I don't have to work anymore. This is how you open your credit back up, right? Did I answer your question? Yeah.
Let's connect with Matthew after.
Oh, I'd love to connect with you. Even if you don't want to talk to me about like finance, you just want to say hi. I mean, I'm totally cool with that. I'll be friends with anybody.
Not a question, but a comment.
Yeah, let's hit that last one. And there's my info with a really skinny photo of my face. Yeah. Look, I took Ozempic. This is what happens. Let's go. Yeah. Thank you. My wife bought me these. Yeah. My wife has great taste. Thank you.
Thank you.